Okay, so let's just get started. Risk reward ratios. So this is all about this. This is kind of a loose, example of just risk management. I'm going to probably go off on a couple tangents as far as like what I use and what I look for. But let's just start with risk reward ratios. So before I even get started with, I think it would be better for me to just kind of ask you like, what comes to mind when you think about risk reward ratios? Are you practicing
Downside
anything?
over upside.
Okay. Anything specific in terms of like the ideal situation for you? Is that something you consider?
Generally it's like when the reward could be as much as 10x, and the risk for your stop loss is like within 5%. So
Okay.
like when the floor is really like when it's really tight, like on this chart, you can see how it's like stepping,
Yeah.
like for me, and it's sort of hitting another floor, and it could be retracing the last one, but that's sort of where you'd put that stop is on that previous that candle wick down on your yellow bar there.
Right. So, okay, let's jump into like I want to like just show you something that I do. That's kind of like a fast way to just calculate. Yeah, just like know right away, like before you take a trade, if the profile fits, if the profile fits like a profitable or probable, situation where you're going to make more money than you would possibly risk to lose. So the quickest way I do it at this point, just to get to 2-to-1. So you want to start with a 2-to-1 risk reward. You want to make at least twice what you're risking, what you're trying to risk. But we'll kind of dive into that. So like for this stock, and I'm just going to do this off the cuff. Let's say CRISP is at 130 even, just for the sake of easy math. What I basically do is I just move the decimal to the left, and that's 10%. So that's 10% of 130 is 13, and that is so. If you were to buy this stock at 130, right, then 143 would be your 10%. And conversely, if you buy it at 130, you automatically now know what 10% is for your gain, but also you just divide that number in half. So 13 is 6.5, and then you just subtract that to your downside. So that's your risk. So 6.5 minus 130 is, I don't know, do the math for me, but it's 23.5 or something like that. So that would be 123.50 would be your stop, and your target would be 143. And right away, you've mitigated quite a bit of risk. So that's just like I know that maybe that sounded convoluted, but if you practice that a couple times, it comes pretty natural. Just whatever it is, it's sub penny, whatever it is, move the decimal once to the left. You've got a tenth. You have a 10% representation of what you need to make.
Yeah.
From that point on, is that
makes sense?
Okay, cool.
Yeah.
So that's my quick way to do it. There's one other way to do it. This is like the more sometimes you might need a calculator way, which is you basically divide the price target gain. So let's say you're buying it at 130 and you want it to hit 150. So that's a gain of $20.
Mm-hmm.
And you just divide that from your stop loss level. It's just a way to kind of filter really quickly. Like if somebody calls a stock out in the room, I can jump in and right away look at the previous high. Like let's say we're going to play this again, previous high right here, and somebody called out CRISP today, and it was at 130, and I'm like, okay, well the price is down here. Let's say they called it out right here at 125, and I'm looking at 130, and let's say I think it's going to curl back up for whatever reason. It's like, okay, is it reasonable for me to assume from 125 to 130 is $5? What am I willing to risk from the past low that looks reasonable? And if I can't find a past low that looks reasonable, I won't do it. So like if my risk,
Agreed.
you know what I mean? You basically look for your reward first. That's what I do at least. I look at what the potential reward could be and if it's realistic. And so if it's, let's say like I wanted to make $5, but I realized that I'd probably be risking $5 as well. This isn't necessarily like down here. Like if I thought I was risking it down to 120 and I was buying it at 125, and let's say I wanted it at 130, well, that's a 1-to-1 risk reward. And So that's not looking good.
No.
And so if I'm stupid about this, if I'm like really excited about buying this stock no matter what, a 1-to-1, you could take that purchase, and obviously it's a bad purchase, and then this is what a lot of people can do. This is my next point with the risk reward ratio: is there's a perceived, don't make a perceived ceiling. Mark whatever ceiling the price action history gives you. That's your reality. And if you're at a 1-to-1 risk reward ratio of like, if that's what it starts to look like before you enter a trade, then don't go ahead and say, oh, well, that just means I have to get to 135. Like I got to make $10 to risk those $5 at the bottom.
Don't look for new highs.
Right. You're basically creating, exactly. You're just like creating these vapid highs for yourself, and then maybe they hit, maybe they don't, but that's where you get into the hope range. So that's pretty much it. I think you're catching on, honestly, like you're hearing what I'm saying. So we can kind of like move forward with that part. But yeah, just the 10% thing works really well for me, because I'm looking for about 10 at least, especially with a swing. It's like, we better start with 10. Like,
yeah.
Like I will skim out at 10 sometimes. That's for a different conversation. But like, at least you're starting at 10%. So it's worth your time.
I've done that before, where it's like, if you just enter a trade, right, then it goes up 10% the next day. It's like, well, maybe it's a good idea to start skimming.
Yeah. I mean, it really, and this is obviously another subject as well, and we can totally dive into this with another session, but like, just the idea of scaling in, and what it means to leverage really heavy, or as heavy as you reasonably can, because that gives you the agency, like the freedom.
Gives you the power.
Skim.
It puts the power in your hands. I honestly, it's really saved me during this pullback this March pullback, basically. Right. So yeah. Very thankful that Chris has showed me that.
Yeah, I mean, man. I mean, we've been kind of discussing this over the last few months, and especially when OTCs were kind of hot in January. I was going in with like a couple 100,000 shares with these double, triple zeros. It's not a lot of money, just a few $100. And then it was like, wow, I should have gone in heavier, because I could have scaled out all the way up on that run, and I would have felt more comfortable if I was just scaling out to actually stay in the play. Obviously, I guess the flip side to that is you're incurring more risk at the onset of that purchase because you've put more cash into the play. But the way to mitigate that is the conversation that we're basically having here, which is like, you have to have your risk reward calculated. And once you absolutely know what those levels are and what has to happen for you, like everything else is left to it's left to the chart. The chart will decide for you, and you've already kind of trimmed out your probability. So like, especially when I'm going in heavy, this is when I definitely need to know, like, I am only going to lose to this level. And we'll get into the psychology part of that.
And that's where you set your stop loss. Yeah. Or mental stop at the least.
At the least a mental. Yeah. And at the most a physical. And I will honestly admit to you, man, this subject, I wanted to talk about this one first with people, because this is one of my greatest weaknesses as a trader, but I also think it's one of the most important like keys to actually successfully trading, is risk reward and controlling your psychology around your risk reward levels, because even though you set them, you might break your own rules. So, but yeah, we'll get into that. I don't know if you've ever done that, but I've definitely broken rules. So
I've definitely done that. No.
Yeah.
No. I've definitely, I don't know. I'm still getting better, but yeah, definitely learning curves all the
time. Let's just stay with this this chart. I'm going to pull out the daily, just because you're in my natural style is swinging as well. Okay, so this is why I like Crisp so much, is just this 200 support, and I'm seeing this curl. I wanted it to close over the 50, but it didn't.
Looks very strong.
But yeah, I'm taking this to, the plan is to take it to 200, but I'm going to shave on the way out when we hit key past resistance. But the next part is, so we talked about kind of calculating risk reward, and you want to start at least with 2-to-1, obviously 3 or 4-to-1. Now you're really getting into like a good situation for yourself. But once again, you shouldn't be lying to yourself about where the stock could go. So beyond like the risk reward ratio stuff, this kind of like expands upon that, which is identifying ranges. in whatever way you do it, like, and we're going to go through moving averages as well, but whatever way you mark your ranges, I want to just like mention the bottom bias part of like selecting your range, like the psychology of picking the bottom of your range, because it really depends on, if you're looking for like an ultimate low of a stock, like just dead low, and by dead low, I mean the lowest it's ever been in its history, then you're at the ultimate bottom of the range. That's what I mean by that. But like, let's say you're just playing, like, see here, like CRISPR is oscillating right here, right? You could have considered this a range trade, and I mean, it didn't repeat itself, but it almost did. It's in an oscillating kind of pattern. So like, let's say you buy down here, and you're like, okay, that actually makes sense, because let's look at the past.
The range could have gone to like 160.
Right. But 100, first of all, is like a fairly solid number. So I always look for just psychological support there. But let's say you set your bottom at 100 and your top somewhere, maybe you thought it was going to go here or here. Like the bias here just isn't, it's very hard to kind of like figure out the range, the range you want to select. So first you really want to kind of determine if you've entered a low position, like what a low position means to you. And for me, CRISPR meant a low position meant contact with the 200. And actually I bought it here. It was like a week or two ago. And because I was anticipating a bounce and it broke right through and I sold it. I was just like, no, I'll just wait until it stabilizes. And so it started to stabilize, and then I picked it up. I picked it up as it regained the 200. You can barely see these candles because they're dark gray, but I picked it up as it regained the 200. Somewhere in here, it still dipped a little bit, and I held it, but like I was just kind of mitigating risk. I'm like, it broke my support. So that was my bottom. I wasn't trying to pick this as the bottom because that was an anomaly to me. I mean, $100 is definitely like an important range, but like this is what I was focused on. And I guess that's the point I'm trying to make, is like whatever you're focused on in terms of indicators, just kind of stick with that. Like that's your guide for the entire trade now. Like you should be setting your levels. You should all of that. You should be setting your exits. You should be determining your risk reward ratio based on the time frame that looks basically the most attractive to you. Because what can happen is if this trade goes bad, you could start convincing yourself by dialing down into like tighter time frames that you actually have a chance. It's like, oh, well, the 200 looks good here. You know what I mean? Like it's bouncing on the 200 here, but let's say it's failing the 200 on the daily. Like long term, it's probably going to eat shit, and you're going to like bleed out really slow. But short term, it's like, oh, I saw support. So it's like whatever time frame you're in. For instance, if I'm scalping, I'm usually in like the 1 minute or 5 minute time frames, like day trading. But for swinging, it's usually day or week. And Swiss, for instance, like some of the biggest plays that he's won on were weekly chart positions, just like way back. And everybody's like, I don't know why he's buying it. Well, here's a great example. Like most people don't go this far back for perspective. These are the same moving averages too. So here's my bottom. If I'm looking real long term, look at that. That's clean as shit. Well, that's not clean, but that's the 50 moving average on the weekly. And it's pinched now between the 50 and I think this is the 20, or it's the 9. Yeah, it's the 9. So, and I'm going to jump into that in a second, but like the moving averages kind of determine my floor. So I just kind of wanted to show you like, and it's okay. Like what you were describing earlier, like to, just kind of mark floor lines for yourself.
Yeah. I use both.
Yeah. I mean, they're usually, and you usually sometimes when you mark these floor lines, you'll see like an intersection of what you marked and the moving averages starting kind of converge around like what you draw.
They're pinching.
Right, exactly. There you go. That's exactly what I like to call it.
It's so you can set yourself with a safety net in case things go bad.
Exactly.
So you can plan your exit.
So, I mean, I think the biggest thing to take away from this is like just kind of like whatever your floor is, whatever you determine your floor is, and it might not, like depending on how the market's acting, you might have to be a lot more cautious. Yeah, but like always respect it. Always respect it. And I got, a lot of us got into bad situations, February up until, this week, because there were floors, and it was just like, no, it's going to come back. It's going to come back. It's like, it's very egotistical on my part to kind of take that stance, and I pay for it almost every single time. So, yep. So this is. So for me, like, this is my floor. Actually, dude, let's go through one of your stocks for the rest of this talk, and then and so we can, like, do some real world stuff. Is there anything you're swinging?
I just took an entry on FSR.
Okay, perfect. And you just took an entry.
The 5-day looks. I've been in and out of this a few times. Last time I got out at 17, so feeling pretty good coming back in way lower.
So let's mark your entry. What's your entry at?
My entry is 1380. I got in near the end of the day, so
mark that. I'll just make a big fat green line, and then we'll kind of go from there. Let's just work the whole thing out, risk reward, and then we'll kind of go through, like, what's the floor. So at 1380, we'll just go from there because that's your purchase, and this is the green line. At 1380, let's find, these are other lines that I've drawn a long time ago, but let's find, like, the next basically, like, solid top, which is, I would argue, right around here, $18. But you tell me first, like, what were you trying to, do you have, like, a pre-planned number in mind for profit?
For profit,
Yeah.
I'm gonna start skimming off at 15.
Okay.
I'm gonna scale out. I'm probably only gonna take 2 scale outs and hold a small position for long.
What's the best case scenario for this trade for you? And I mean realistically, like, you don't have to go overboard, but, like, for instance, if this is the previous top at 18, let's just mark up, like, a serious level. And FSR moves in, like, solid numbers for them. You know what I mean? Like, it tests, like, one solid whole number every single time it ticks up or down. It seems to kind of resist a little bit. So
yeah.
So 1380, and you said you're going to start scaling at 15?
Yeah, I'll probably be out of it before 20 even.
Okay, but whatever you want to mark it as, and then we'll figure out your risk. So you think 20 is, like, you can be scaling out this whole time, but what would be your top target?
I'd say 20.
Okay. I'm just like, whatever you had in mind. So let's just go with that for right now. Let's say the ultimate target on this entry is $20, which means we're going to need, so that goes from, let's just say $14 to $20. So let's do the 10%. So 10% of 1380 is $1.30. So you need at least $15.10 to hit your 10% mark. So that's what we want to mark first, is just kind of like, let's just get that out of the way. Like, we need to get there. I'll put it in yellow. So that's a fairly reasonable trade considering the previous high, right? It matches up with this candle. And so when you talk about, I'm going to start scaling out at 15, like a whole number, that's actually really smart. You're going to start scaling out at 10%. That's, like, actually the best. I mean, as weird as this might sound, this is why you take it in weight. You take it in heavy weight, and now you can just scale out, like, say 20% of your holdings, 30%. Don't feel too, like, you don't feel that itch of, like, oh man, I really screwed up. So you're still, like, very much in the trade. So next level would be, and you want to skim out to 20. So let's just say, and I can see this right here, we're just going to look at past highs basically. And I was marking 18 before. So let's say you scale out 15. So, but already you're in a realistic trade. So if it's $1.30, we're going to be risking 60-something, 65 cents. I don't know.
Like that, something like that. Yeah. I had this done already.
1380.
Yeah, it's 70 cents. So 13.10.
13.10.
Yeah, my stop is, or my mental stop at least, was 13.20. I figured this out, so that works out.
So, and it looks, once again, like, as we're marking this up, it's kind of correlating with the chart, which is great. So that, I mean, you can even see, I'm sorry, I have all these other lines, but, like, you can see between these 3 lines, you've got you got double the space here, so you're good to go. And so what made you buy 1380 under this 200 SMA?
Because it seems to always, or at least last time, it shot back through the 200 SMA and kept its
Okay.
bullish momentum.
Okay.
So,
And I understand,
volumes.
I understand from this, I'm looking at your drawing. I don't know if you can see me looking at it, but I'm looking at it.
Yeah.
So the first circle where you're representing, hey, it went under the 200 and came back up. Man, that could have been a good dip buy. And here again, you're grabbing it where there's a perceived floor. There's a perceived floor here because there isn't actually a technical floor.
No.
Like if you look at it, the assumption is there that it's going to go over the 200 and you just got a deal, which is true if it actually goes over the 200. The problem is if it doesn't go over the 200.
And it's yikers. Then we out.
Yeah. But it's also hard because it's hard to get at. Obviously, we're establishing your floor based on just where you entered, like your risk reward floor. But it's hard to kind of determine where that floor is when you're at a perceived floor. So, and I'm just giving you my own opinion on this, and the other guys might actually have a completely different opinion. But I'll tell you how I would manage the risk on this trade, and you're probably going to be more than fine, but to manage the risk on this trade, just like if we're day trading and following like the VWAP, I'm not sure if you keep that on your chart, but when we're following the VWAP, it's like any other indicator, like the 200. I want to see a reclaim of that line first. That's what I want. I know it's eating shit. We can see that FSR is eating shit. That's okay. So let's go back to the chart that I mucked up a lot. But like it's this red line right here. That's the 200.
Yep.
Okay. So if I'm looking at this,
it
hasn't reclaimed, and which is going to bring me to a bigger point about the 200. But like you can see obviously this would have been a great deal. And I think as you become more sophisticated, and I know people think they have the finger on the pulse of a stock sometimes, but if you truly want to mitigate your risk, good traders are buying on the way up when they see these breaks. Like this is the confirmation. Like this would have, and I told you before when I was playing CRISPR, I saw that cross in CRISPR and I was like, okay, and I took it and it went back down. I'm like, no, I'm out. And then CRISPR went back up and I took it again and now it's going. So it's not whether or not the trade always works. You know what I mean? In terms of like your strategy of entry, it's just, you just got to know where that absolute, like where your green light is, like what's going to activate you to go in heavy and what's going to tell you, no, this isn't working. I'm back out right out again for 2% loss. And now I'm back in CRISPR. I lost like $60 on CRISPR or something the first time. And now I'm up like 300 today. So the patience pays off. You just have to wait for it to move in a way that confirms the floor. So the ultimate floor to me in terms of like, if I'm looking at a daily or weekly, is the 200. It's the 200. Like if you really want to get a great deal on a swing, that's the support I'm looking at. Like that's what I'm looking for at least. Let me move this back a little bit. That doesn't mean this isn't a play, and it doesn't mean you didn't get a good deal here. It's just now you know, hey, I'm not taking any less than this. I'm already forced under one of the strongest moving averages you can look at on a long-term chart. Like you're already suppressed under that. Yes, you could totally break through, just like this time. There's a high probability you will. FSR's got a lot of momentum. Look at the MACD. And I'm not sure if you follow that, but it's
I have the MACD and RSI up.
Coming back up. RSI is oversold. So yeah, it's definitely got the potential to do it. But now you have a better idea of like, if you're marking,
so let's go.
Yeah, exactly. When to enter, and you can time your entry. And it's not, and you will, I'm telling you right now, you will lose out on gains that way. But you will also avoid getting bagged so much more if you just let these things work, if you let these lines work for you. Let the lines tell you the truth, and as soon as they say go, just go with them. And if they give up on you, just get out. Like it's really not worth the time or effort to stay in a swing very long if it starts going the opposite direction that you initially bought it in. And I know I hear people say a lot like, oh, I'm buying it at 15. But you know, I plan on buying more at 14. It's like, what the hell is that? Like, that's not a good mental way to enter a trade. You're like, you're already convincing yourself that it's going to go lower. Like, you already think it's going to go lower, but you're willing to buy it here. That's weird to me. Like, just let this stuff come to these moving averages. I let CRISPR do it. You know, FSR is going to come back up, and see where you want to profit here, where we were talking about like around $15 is where you're going to take that 10%. Well, right over top of 15 is the 200. So you better be you better be certain if and when it comes up here, it's going to resist it for a second. So 15 is actually a pretty good sell because this particular range, like you're coming up to the top of a range right here. The 200 is kind of like it either breaks through or it doesn't. So FSR will experience resistance. Will it break through? Probably. This is like a wild stock and it always gets good volume when it ramps up. So, but the point is if you see hard resistance here, and I mean hard, like if it bounces off the 200 and starts to go, there's no reason why you should be losing any more profit. Take it, just take it and let it come right back down to either where you bought it before or down to down to the ultimate low of where it was. This is how you can kind of range trade. You need to be determining like if this is the top of the range, which I would say it is because this is the 200, then like that's where you want to be focused on profiting them, like in terms of just making a very decisive move. Just take something right there. And if it breaks through, great, keep taking it up all the way up to, if it breaks through the 200, you're going to be in good shape. So like it's going to want to continue if it closes over the 200, it will want to continue the next day, just like it did on this past recovery. Let's find, I mean, we can probably find more examples. FSR is it's not a good example because it lays flat because it's a SPAC and it doesn't have a lot of history. But like you can see why I bought CRISPR, man. Like the history of CRISPR is we don't go below the 200. So when it came down, here, I got real interested, and that's the first time I bought it. And then and I sold it somewhere up here because that was my first previous high target, around 138. And now I'm back in it. This is like, it's clearly, this is for most, you know, even mid cap or higher quality stocks, like they're all going to do this. They all tend to respect in some way, whether it's support or resistance to 200. So that's what I look for my ultimate floor, basically. And really, man, if you have like a lot of, we all speculate on different stocks. I just set the alert. I set alerts on stuff now, right above that 200, maybe like a, you know, depending on if it's $100 stock, I'll set CRISPR at like, right now 200 is at 120. So if I was looking for an entry, I'd set CRISPR at like 122 alert, 122 or lower. And as soon as I hear the alert, I'm like, oh yeah, it's time to buy CRISPR. I'm not thinking about it. I wasn't even thinking about, I was scalping pennies this morning. I had 4 prepared last night. I knew exactly where I wanted to buy them, and I set alerts in my trading app. So I'm using Thinkorswim. So if you can set alerts, like alerts are so critical because it takes your emotions out. Like this is a good question to ask because I did this my first 2 years trading. But have you found yourself in the past kind of like you take a trade, like you take an entry and you just watch it like forever, or you're interested in something and you're just watching it all day, like tracking?
Yeah, I don't do that anymore.
Oh, that's great.
I've done that. Yeah.
But that's so important, is just kind of emotionally removing yourself. So like there's a lot of ways to do it. I think one way is just to kind of, you're busy. You're busy and you don't have time to like track this stuff. And the people that do it can drive them crazy. So yeah, man, alerts are great. Understanding like mentally where you're going to get out is great. If you ever found yourself like I did in the last 2 months, I would say, where I disobeyed some of my stops. 3 weeks ago, I started setting hard stops. And I got stopped out a lot, but for like 3 or 4%, as opposed to me psychologically letting the trade break down. And now I'm not setting hard stops. I just know where my stops are again. It's almost like I just had to kind of remediate myself really quick. I think a lot of people do, like we all lose control a little bit. I don't know anybody in this group, including management, who hasn't had like a rough time, like trying to maintain control of their strategy. you just lose it a little bit. So it's always good to kind of like put some of these mitigation rules in place just to kind of help you like remove the emotion from it. But it sounds like you've got that, at least you're starting to work that part out, which is great. I think, honestly, I think it's the biggest barrier to profitability is being able to control where you select stuff. Averages, just to make sure. I want to just show you what I use, which is on the chart basically. And but I'm curious what you use.
I use the 200, 50. I have a 20 and an 8 set.
Perfect. That's okay.
I use the 20 and the 8 more on the 1 week.
Okay.
But they're for shorter term stuff. But
sometimes
they come in handy. Sometimes they work on the longer run, but not often.
Yeah, I mean, I think, you know, here's a great example too. And so the orange one, by the way, is the 180, and that has to do with prime numbers. That's something Swiss really likes to follow, because a lot of times we'll find that direct bounces come off the 180 and not the 200. But if you really want to simplify your view, I actually might take the 180 off soon because it's just too many lines, and I like a really clean chart. Let's do it right now. I know Swiss likes this, and I don't blame him. Like, it really works. It actually does show up in the OTCs quite a bit. I'll do it later. But the red's 200. I pretty much all the levels you said, 200, 50, 20, which I don't use anymore because I'm looking for powerful levels. So if I get too granular, remember when I was like talking about like the ultimate floor?
Yeah, too zoomed in.
Exactly. And like, okay, so a stock's coming down to the 50 and we're like, oh, that's the floor. No, it's not. It's going to the 200. So that's what I mean by like getting too granular. Is like, if we start to look at shorter moving averages, your support becomes a little bit more lofty in your mind. You're like, yeah. Is this going to ride it up?
Bagged. No, that's gotten me bagged before, 100%.
So, and if you think it's riding it up, right? Like, let's say you bought it on the 50 here. And okay, maybe you made a bad decision, maybe you didn't. If it breaks below the 50 and closes below the 50, you're out. That's it. That was your floor. You determined that floor ahead of time. That's your floor. Your floor now doesn't become the 200 because you wishfully think it's going to bounce again. Like, that's it. Game's over. And then you get to wait. Like I was talking about with this very stock, you know, you just wait for it to eat shit again, and it did. Guess what's coming up? Calling it right now. I swung this twice already. NVIDIA. I'm not telling either one of you guys to, hey Dave, I don't know if you can hear us or not, but I see you there. Okay, welcome. So but here's another pretty nice, clean example of a range trade. I bought NVIDIA just because I knew that, you know, this was like a research stock for me, and it was kind of it was barcoding for a while, and I knew there was value about to get pumped into the stock because they bought just a really important microprocessor company. It started to go up. I sold somewhere near the previous high, but that was it for me. When it started going down, I wasn't thinking about dip opportunities until it got to the 200 and ate it. And then when it reclaimed, I took it again. I took it off the 200. And because I took it off the 200, I had enough of a risk reward ratio, because it's a pretty good floor, that I was able to withstand this dip. You know, my 2-to-1 was like, my gain was way up here. I was looking at 600 for my exit, and I'm picking it up at like almost five. My original entry on NVIDIA was 490, and I sold it at I want to say 570 is where I sold it at. I was pissed because it kept going, but you can't be angry about that kind of stuff. Look for your previous high, take the target. Like that's where I sold it. I sold it as it was approaching this previous high on this last run, right around here. That's all right. I captured the move. You know what I mean? Like, I mitigated my risk, and I'm back in cash. So now it tops out. You know where it's going. You know where it's going to go. Maybe it bounces the 50, but it's probably going to touch the 200 again. And am I going to do anything about that? Like for the next week or so? No, I'm just setting it. You can see my mark. I marked 530 or below. As soon as it falls below $530, I'm on alert. I'm in buy mode, and I'll take it on a clean bounce of the 200. That's it. And if it fails that, you know, more than my reward ratio, which is now I'm going to be shooting for almost 650. And if I buy it around, let's say 520, That's however much money. If 520, 10% of 520 is 52. So I need to make 570 and I'm shooting for 650, which is realistic. That's realistic on this swing. So I'm already way exceeding 10%. And if I buy at 570, 51, let's say 25 is about 2-to-1 risk reward ratio. So I'm risking almost nothing for, it's almost a 3-to-1. This is a 3-to-1, I think. I'd have to do the math on it, but I'll do the math as it gets closer. Then I'll get more interested. But like the 200 is where, that's it. There's no other rules. It's just pick the moving average that makes the most sense to you, and play that. Now, let's say you're really aggressive trader, like, no, I only buy on the way up. That's what the 9's for on the daily. If a stock is running, you'll see it just bounce the 9. Always, every time. Day trading, 5-minute chart, same thing. 1-minute chart, same thing. Look at that. 9, 9, 9, up the yellow line. 9, 9, up the yellow line. Okay, so that's basically it. Like if you're on a run, obviously sell where you said you were going to sell, regardless of what you see, even if you see this kind of bouncing stuff happen. That's obviously very bullish, but you know, maintain your sells. So I guess the last piece of advice is set hard sells, even if it's not the whole lot that you originally bought. Set a hard sell for yourself. Like know that you're going to profit somewhere, and mentally kind of prepare yourself to make money. That's the way to do it. And so like when I see a top here, like it's 615, I really just want 600 at this point. Like we're already topping out. So, and it's a whole number, and whole numbers are powerful with these large caps. So that's all I'm basically being reasonable. And by being reasonable, I'm mitigating a ton of risk. The only other thing I want to say about the moving averages is, well, two more things. Two moving averages, these, what we just talked about, 250, I just do 250 and the 9 EMA, which basically, by the way, Trevor equates to the 8 EMA, or the 8 MA, excuse me. It's the same thing. It's an accelerated moving average. So, so either will work, whatever you want to use. If you use the 20, that's fine. I'm just showing you what works for me, because like I like to reduce the noise. But the only other thing on here that I really want to point out before we jump off, and I promise this is the last thing, is the Parabolic SAR, which is this blue line. So Trevor and David, do either one of you use this?
Nope. I've played with it, the Parsar.
Yeah.
Kind of watched it, studied it, how it behaves, before I start actually relying on it.
Yeah, it's definitely not something. None of this, by the way, none of this is something to rely on solely. None of it. Not even the 200. I mean, you can definitely trade strictly off the 200, but you know, I want to see a confluence of indications. I don't want just one or two things to. I used to depend on the RSI when I was a new trader. That was a huge mistake. So but here it's the basic premises. So David, did you have it as dots? Did you set it up as, was it looking like dots on your screen or a solid?
It looks like dots.
Okay.
Yeah.
Okay. So are you in Thinkorswim?
Yes.
Okay. So, and Trevor, I don't know exactly what your platform is, but hopefully it can pull this off, the Parabolic SAR.
Yeah, I can just go on Yahoo Finance.
Okay, cool. So almost every platform tries to draw it as dots. Go into your options and draw it as a line. It will monumentally help you see how this indicator does not work for me in dot format. If you see this in a line, you understand what's going on. You can see it visually. So I'm going to show you visually now. You'll see the pattern very, very quickly. When the Parabolic SAR line is above the price action, it's suppressing the price action. Just consider it that way. Think of it as a suppression. As soon as you see a crossover, you've got bullish momentum. Here we go again. Suppression. Crossover, bullish momentum. You'll see this up and down the line. Now, this doesn't always work. Sometimes it levels out and fails. There are instances where it does that. Look at here. I mean, so here we go again. Crossover, acceleration, suppression. So whenever you see this flip, whenever you hear Swiss or I saying, "Oh, we got a Parsar flip coming," what we're seeing is, I'll zoom in so you can so I can really make this clear. As I'm watching this on a daily chart, for instance, as a swing trade, I've got other ideas going on. Maybe I've marked a floor around here, stuff like that. Like maybe I want to buy somewhere down here. That's fine. But I'm watching this parabolic SAR, and I'd be on a little bit of alert because it's getting close to the price action, but look at what happens as it gets tighter and tighter to the price action. It becomes more and more wound up, and the likelihood of it flipping becomes very, very high. Same thing on the opposite side. You can see as it starts to travel up, there starts to be, just like you said before, it starts to pinch up to the price action. See the space between it starts to reduce. And in my experience, what happens is when I see the parabolic SAR make direct contact with a candle, now we're on to something. Now we've got a flip that's almost guaranteed to occur. So if I see direct contact with a candle, then I know, like here, zoom in on this so it makes a little bit more sense. So here the Parsar comes down, makes direct contact with that candle. I would be starting to get like a little bit bullish. It's like, okay, we got direct contact here. The flip is either going to happen today or it's coming very, very soon. So I have an idea that bullish momentum is still occurring. And then I combine that with like, oh, well, the 200's right here. We're flipping right here. This is a very low point to like take an investment in terms of risk. And I set my risk reward from there and let it bounce. But the point is like seeing that direct contact on the price action with the parabolic, there goes the flip. And here we go. This is why I like NVIDIA. I don't like it to buy right now. I like it because it's coming down to my buy. Look at the flip. This is also a custom code I wrote with my brother. I can share with you guys later, but there's the flip. And now we know it's under heavy suppression. And not only the suppression is pretty powerful, the harder it flips. So like it takes a while for the price action usually to get back to fighting the parabolic. I would have started to get nervous here. That's where I would have been selling, just in terms of like it's bouncing on the 9, it's getting close to the Parsar, it could flip at any moment. Things are getting kind of hot. But that's just something to keep in mind is like I think it's a really useful tool. It works really well on just like the MACD. I say the MACD works really good on like longer term time frames, like daily, weekly. That's when you can kind of start to trust it a little bit more, and the 4 hour. But I like this on the daily and weekly, and the weekly is just it's wildly helpful. And if you I don't do you guys play OTCs much?
I love OTCs. I was married to Strikeforce for the last 3 months, and
okay.
we had a rough time there. I plugged back into it, but I love OTC. Yeah.
Here's an instance, David, where that flip happens and it still breaks down. It flipped bullish and it still broke down, and then it flipped bearish and it really broke down. But like, so it's not something you can 100% trust. You have to be using other levels as. I mean, look at the 50 on this on the daily. That tells you, I mean, look at this bounce, resistance, and then, or support, excuse me, and then boom, resistance. So you know what this 50 is going to come into play as it starts to rise back up. But the point is longer term timeframes on OTC. It's very helpful to look at the weekly and give yourself an idea of how much suppression is actually going to occur long term. So as I stretch that out, it's like, oh man, S4, let's say you're speculative on S4. You haven't bought it yet. I'm going to wait a little bit longer. Let's wait till like the 3s, maybe 4s, 3s. I like to think about worst case scenario with OTCs, so I get in super low risk. But that's all I'm saying is like when I see the Parsar way up here, it's like that would take a miracle for that. I mean, we're looking at the weekly. It would take several weeks for that to somehow overcome and become bullish again. So in the meantime, it's just, this is what patience is. You see this kind of stuff long-term. And if you're scalping, it's a different story. If we're granular on the 5-minute chart, that's a different story. But if we're trying to swing and like make decent returns on these things, it's best to just kind of sober yourself. You got to back all the way out, sober yourself up. And it's like, okay, this still is like not looking so hot. And you can see it's very microscopic. But when Swiss and I are hunting OTCs, that's what we're looking for. Look at that direct contact with the parabolic. It's bottoming out. It's barcoding, flip, boom. And as soon as it flipped, look at all that volume that came in when it flipped. The parabolic, when the parabolic flips, last point, it triggers algorithms. As right, if it's a day trade or a swing trade, when the parabolic flips, you will see algorithms trigger and more volume comes in. It's just a automatic happening when it happens. So they're watching it too. Just know that algorithms are definitely on this.